The average American is leaving $500,000 on the table over their lifetime. Not because they don't earn enough, but because they never learned this. In the next 10 minutes, I'm going to show you exactly how to build an investment portfolio from scratch, even if you have zero experience and less than $100 to start. Warren Buffett has been saying this for 40 years. Wall Street doesn't want you to hear it. Here's how to build a portfolio the right way, starting today. For more, let's go.
Think of an investment portfolio like your financial team roster. You wouldn't build a championship team with only quarterbacks, right? You need different players for different situations. Same idea here. A portfolio is simply everything you own: your stocks, your ETFs, your bonds, maybe some cash on the sidelines. The whole point. Don't put all your eggs in one basket. When one asset drops, another holds steady, or even climbs. That's called diversification, and it's the single most powerful tool regular Americans have against market chaos. The S&P 500 has crashed dozens of times in history, but diversified portfolios, they've recovered every single time.
Let me give you a real American example. In 2001, thousands of Enron employees had their entire retirement savings in company stock. When Enron collapsed overnight, those people lost everything. Not some of it, everything. That's what happens when you bet it all on one horse. Now flip the script. If you'd held a simple diversified index fund in 2001, yes, you would have felt the dot-com crash. But within a few years, you'd have fully recovered and kept growing. Diversification isn't about getting rich fast. It's about never getting wiped out. Spread across stocks, bonds, real estate, and international markets, and no single disaster can ever take you down completely.
Every serious portfolio is built from the same 4 building blocks. Let's break each one down in plain English. Stocks, your growth engine. When you buy a stock, you're buying a tiny ownership slice of a real American company. Apple, Microsoft, Amazon, Google. Stocks have the highest growth potential of any asset class, but they also swing the hardest. In a great year, your stocks might jump 30%. In a bad year, drop 40%. That volatility is the price you pay for long-term gains. Historical average return of the S&P 500, about 10% per year over the last 100 years. Nothing else comes close. ETFs, the beginner's best friend. An ETF, exchange-traded fund, lets you buy hundreds or even thousands of stocks in a single purchase. Instead of picking winners and losers yourself, you own a slice of everything. VTI gives you the entire US stock market for less than $300. SPY tracks the S&P 500's top 500 companies. Low fees, instant diversification, no stock picking stress. This is why financial experts call ETFs the most beginner-friendly investment ever created. Bonds, your portfolio's seatbelt. A bond is essentially a loan you give to the US government or a corporation. They pay you back with interest. Bonds don't grow as fast as stocks, but when the stock market crashes, bonds typically hold steady or even rise. That's why every serious portfolio includes them. US Treasury bonds are backed by the full faith of the American government, the safest investment on the planet. Cash, your financial airbag. Cash isn't just money sitting around doing nothing. In a smart portfolio, cash held in a high-yield savings account is currently earning 4 to 5% annually, better than most bonds a decade ago. Cash also gives you what Wall Street calls dry powder, money ready to deploy when markets crash and bargains appear. Rule of thumb, keep 3 to 6 months of expenses in cash. Always.
Alright, here's where it gets real. Let me show you 3 actual portfolio blueprints you can start using today. And I'll show you exactly what $10,000 looks like inside each one. Portfolio 1. The Conservative. Built for protection. This is the portfolio for someone who cannot afford big losses. Maybe you're retired. Maybe you're within 10 years of retirement. Maybe you just lost sleep during the 2022 market crash and never want to feel that again. With $10,000, you'd put $4,000 into stable dividend stocks or stock ETFs. Think Vanguard's VYM or Schwab's SCHD. Another $4,000 goes into U.S. Treasury bonds, or BND, your financial seatbelt. And $2,000 sits in a high-yield savings account, earning 4 to 5% right now. You won't get rich overnight, but you won't get wiped out either. And in America, that peace of mind, that's worth something. Portfolio 2. The Balanced. Built for steady growth. This is the classic American portfolio. The one your financial advisor probably recommends. The one Warren Buffett has suggested for most regular investors. With $10,000, $6,000 goes into a mix of U.S. stock ETFs and international exposure. Think VTI for the total U.S. market, plus VXUS for international diversification. $3,000 goes into bonds. BND is perfect here. And $1,000 stays cash. Historically, a 60-30-10 portfolio has returned around 7 to 8% annually over the long term. On $10,000, that's your money doubling roughly every 9 to 10 years without you doing a single thing. Portfolio 3. The Growth. Built for maximum wealth building. This one is for the 20 and 30-somethings watching right now. If retirement is 30 or 40 years away, you have the single greatest asset in investing on your side: time. With $10,000, $9,000 goes almost entirely into aggressive growth ETFs. QQQ for tech-heavy growth. VTI for broad U.S. market exposure. Maybe a slice of SCHG for large-cap growth. Only $1,000 stays as cash. Yes, this portfolio will swing hard. In 2022, it might have dropped 30%. But zoom out, the S&P 500 has never, not once in history, failed to recover and reach new highs. Time turns volatility into wealth. I want to show you something that will genuinely surprise you. You don't need 47 different investments. You don't need a financial advisor charging you 1% a year. You don't need to watch CNBC every morning. You need exactly 3 funds. That's it. 3 ETFs. And you'll own a piece of literally every major company on the planet. Let me show you the most famous, simple portfolio in American investing history. The 3-fund portfolio, pioneered right here in the U.S. by Vanguard founder Jack Bogle. Fund 1. U.S. Total Market ETF. First, VTI. Vanguard Total Stock Market ETF. 1 purchase. 3,700 American companies. Apple, Microsoft, Amazon, Google, Johnson & Johnson. Every major U.S. company, large, medium, and small, all in a single ticker. Expense ratio? Just Mito Fardo, 3%. That means on $10,000 invested, you pay Vanguard exactly $3 per year in fees. $3. That's less than a Starbucks coffee. This is your core growth engine, the heartbeat of your portfolio. Fund 2. International ETF. Second, VXUS. Vanguard Total International Stock ETF. Because America is powerful, but it's not the entire world. VXUS gives you 8,000 companies across Europe, Asia, emerging markets, and beyond. Samsung, Nestle, Toyota, LVMH. Companies dominating their home markets that Americans rarely hear about. Why does this matter? Because there have been entire decades where international markets outperformed the US. The 2000s, for example. Owning both means you're never fully left behind, no matter which economy leads. Expense ratio, 0.05%, nearly free. Fund 3, Bond ETF. Third, BND, Vanguard Total Bond Market ETF. This is your portfolio's shock absorber. BND holds over 10,000 U.S. bonds, government treasuries, corporate bonds, mortgage-backed securities. When the stock market crashes, and it will crash, BND tends to hold its value or rise. In 2008, when stocks dropped 37%, bonds gained. In the COVID crash of 2020, bonds provided critical stability, while stocks fell 34% in weeks. BND is what lets you sleep at night while still staying invested. Here's something most beginner investors never think about, and it quietly costs them thousands of dollars. Imagine you set up your perfect 60-30-10 portfolio in January. Stocks, bonds, cash, exactly where you want them. Then the market has a great year. Your stocks explode upward. Suddenly, without touching anything, your portfolio is 78% stocks, way more risk than you signed up for. Now you're one bad market day away from a gut punch you never intended to take. That's why rebalancing exists. Rebalancing is simply hitting the reset button. You sell a little of what grew too big, buy a little of what shrank too small, and restore your original targets. Most Americans should do this once or twice a year. Set a calendar reminder. January and July. Done. Some brokerages, Fidelity, Schwab, Betterment, will even do it automatically for you. That's called auto rebalancing, and if your platform offers it, turn it on right now. Bottom line, rebalancing keeps your risk level where you chose it, not where the market accidentally put it. Before you invest a single dollar, watch this part carefully, because these 5 mistakes have wiped out more American wealth than any market crash in history. And every single one of them is completely avoidable. Mistake 1. FOMO investing, fear of missing out. January 2021. GameStop stock explodes 1,700% in 2 weeks. Reddit goes insane. Your coworker brags about tripling his money, so you buy in. At the top, 3 weeks later, GameStop crashes 90%. Your coworker stops talking about it. This is FOMO investing, chasing what already exploded, buying the headline, not the fundamentals. It has destroyed more American retirement accounts than almost anything else. Rule: if it's on the front page of CNN, you're already too late. Mistake 2. Overtrading. Doing too much. The average American investor dramatically underperforms the market, not because they pick bad stocks, but because they trade too often. Every trade triggers fees. Every sale in a taxable account triggers capital gains taxes. And study after study shows that the more frequently Americans trade, the worse their returns get. Mistake 3. Poor diversification. The one basket trap. We talked about Enron earlier, but this mistake is still happening right now. Millions of Americans hold 80% of their 401k in their own company stock. Tech workers load up on their employer's shares. Crypto enthusiasts go all in on a single coin. When that one bet fails, and statistically, single stocks fail far more often than indexes, there's no safety net. Own everything. Owe nothing to any single company's fate. Mistake 4. Panic selling. The most expensive emotion in America. March 2020. COVID hits. The market drops 34% in 33 days, the fastest crash in American history. Millions of Americans panic sold everything, locked in their losses, moved to cash. The market fully recovered in just 6 months and went on to hit all-time highs. The investors who did nothing, who sat on their hands and watched Netflix instead of their portfolio, came out wealthy. The panic sellers, they locked in losses and missed the entire recovery. Panic selling is the single most expensive financial decision most Americans ever make. Mistake 5. Taking on too much risk. Investing money you can't afford to lose. This one is personal. Investing your emergency fund, taking out a loan to buy stocks, putting next month's rent into crypto. When the market drops, and it always drops eventually, investors who need that money are forced to sell at the worst possible moment. Only invest money you won't need for at least 3 to 5 years. Your emergency fund stays in cash, always, no exceptions. The best investment strategy in America isn't the smartest one. It's the one you can stick to when everything feels like it's falling apart.
The best portfolio isn't the most complicated one. It's the one you can stick with for years. Start simple, stay diversified, invest consistently, and let time work in your favor. Like and subscribe for more investing education. See you in the next video.